So, Sarah, let me start with you on the equity side. Despite all the news that came out, and there was some up and down, the equity market just kept going up, although not quite as fast as it had.
Equity markets and bond markets definitely became disconnected this week. This is around the great debate around economic data and also inflation. We saw cooler CPI data, hotter PPI data. Our view is that the cooler CPI data wins out because the factors driving that down are more permanent, such as lower used car prices and also a shift of spending from goods to services. While the PPI data is hotter, but that's around the one-time reopening. Other data points we watched this week were the infrastructure package, $550 billion in new spending. That's good for industrials. And then, of course, consumer sentiment coming in at the lowest level in a decade. It is Friday the 13th, but we're not all doomed. If you look at consumer sentiment, it's not always tied to consumer spending. We saw low numbers in the fourth quarter of 2020, while equity markets still produce positive returns. We're watching economic data like the Conference Board data, which remains over one standard deviation above its mean.
I actually saw a Bloomberg chart today suggesting that the markets often go up on Friday the 13th. This is the only one this year, though, I'm happy to say. Nancy, let's turn to you because you've made something of a name for yourself in investing in and around inflation, really knowing how to take this into account as an investor. What do you make of those CPI and PPI numbers, which seem to go a bit in different directions this week?
Well, I think if you look at the long-term trend, if we start at, say, the first quarter of 2021, the 10-year yield was 175, and then we've had 4 CPI prints well above the 2% target from the Fed. We had 4.2 first, then 5, then 2 5.4 prints, and you would kind of scratch your head, and if you had a crystal ball at the start of Q2 and you knew the CPI prints were going to come in that much higher than 2%, what would most rational people do? You would sell bonds because you would think yields would be going higher, but it's opposite day in the markets. And yields have done nothing but go lower with all these higher CPI prints. So I think there's definitely something screwy going on in the markets where nobody believes inflation is actually going to be here, because why would you be locking up your capital? To your point, David, that the 10 years under 1.3% right now, that doesn't make any sense if you actually believe that inflation is coming.
Yeah, and we had any number of experts saying sell bonds, sell bonds, sell bonds, because the yield is just going to go down as a practical matter. But Sarah, you're an equities person, not a bond person. But how much of the support of the equities markets that we're seeing is exactly because of what Nancy was talking about? Because yields actually have been very tame. People were talking about 2.0 I'm talking about on the 10-year.
I mean, that's definitely makes equities look more attractive. From an equity portfolio point of view, we're definitely saying you need to become more selective here. First of all, you need to look for those companies that have the pricing power to overcome these inflationary costs. We're also seeing profit margins at about decade highs for companies. So these companies also need to be able to raise prices in order to drive their margins higher. Areas that we think are attractive are actually small caps. They're now trading at the largest discount to large caps that we've seen since September 2020. They're back at valuation levels of January. They tend to do well in periods of rising inflation and interest rates. And we like industrials because as that infrastructure package kicks in, industrials will have that cyclical tailwind behind them to help them grow their businesses and increase their profit margins.
Well, and it's not just the infrastructure package. We now have the Democrats in the Senate at least saying would like another 3.5% incremental spending in that sort of second wave, the Build Back Better plan, as President Biden calls it. So Sarah, if in fact that comes to pass, and forget the 3.5, suppose it's just 2 or 2.5, what does that mean potentially for investors?
I mean, for investors, I think it means we have more confidence in economic growth going forward. If you look at 2022, third year past the recession, market returns actually tend to be pretty strong. We see high single-digit earnings growth next year. That's not recessionary levels. It's not where you would be for a bear market. We think that drives markets higher rather than valuations, and that's supported by economic growth. Now, we do have 2 headwinds next year. One is how are we going to pay for that infrastructure and all that spending? Probably higher taxes. That's going to negatively impact that earnings growth number. And also, we need to worry about taper timing. The Fed's been taking baby steps towards taper timing. We think they're watching August payroll data. If that looks as high as July data, we think the Fed could announce tapering in September and start tapering in early 2022. But as long as the yield curve doesn't flatten, we think that markets can remain with positive returns even through tapering and higher interest rates.
So Nancy, I don't want to misquote you, but I think you said the markets were a little bit screwy, I think was the word you used. Now, given what the CPI numbers have been being and what the year-over-year inflation is, despite the fact people don't think it's going to come, how much of that do you think maybe because of the Delta variant, that people are really subdued? And we had really stunning numbers at the end of the week on the consumer confidence out of the University of Michigan, the lowest, I think, in 11 years. How much of that is really constraining some of what we otherwise might have with consumer spending?
Well, I think to Sarah's point, the yield curve is the most important measure to be watching. It's very forward-looking. And since the Fed's June FOMC meeting, we've had the largest flattening in the forward yield curve since the financial crisis. And that should be ringing the alert for equity and credit investors, because corporates are priced to perfection, right? Everybody's expecting growth. Everybody's expecting earnings per share. But what if we actually have higher labor costs or shortages of goods and services or shipping delays? All those things, the yield curve is expecting has had a massive flattening. And that's also because the market has priced in the Fed hiking rates. And so we really see it as an opportunity. And that's what we've been taking advantage of in the IVOL ETF to express a steeper yield curve because we think that forward flattening has been overdone because it doesn't make any sense with all these high CPI prints that people are willing to buy long-dated government bond duration and not get any return for their capital.
So, Sarah, Nancy says that the yield curve really is so important to what we have. Is that right? And if so, what does it tell us about what the Fed is likely to do, given the numbers that they're seeing right now? Because we were thinking they're heading toward tapering pretty soon. This week, there's some hesitation about that. I think maybe it might be a little bit longer before they taper.
I agree with Nancy that the yield curve is the key. Oh, go ahead, Nancy.
No, Sarah, go ahead.
I just say I really do feel like the yield curve is the key, as Nancy mentions, in terms of what it reflects going forward. And while we are past peak economic growth, the economic data points still remain very expansionary. Inflation data, from our point of view, is telling us that while it's likely to end up at higher levels than it was pre-pandemic, we don't think inflation is getting out of control. The key factor to watch there is wage inflation. Only in leisure and hospitality sectors are we at elevated levels beyond pre-pandemic levels when it comes to inflation. The rest of wages actually look quite tame to us for now. So, we think our view is that strong economic data remains in expansionary territory going forward. Inflation remains fairly mild, and therefore you don't remain in a situation where the yield curve flattens. And the Fed can taper and raise rates, tapering in early 2022 and raise rates likely in 2023.
Sarah, I'm sorry, Nancy, what were you going to say?
I was going to say that an upward sloping yield curve is a very healthy sign for financial markets. If you think about what our banking system, the way it operates, is lenders borrow short term, typically in the repo market or the commercial paper market, and they make long-term loans to small businesses in Main Street. So I do think investors really need to keep an eye on what's going on in the rates market to get indications about what investors are thinking, because that upward sloping yield curve is actually a very, very healthy sign to get all the capital that's in Wall Street out to Main Street. And that's what we try to take advantage of in our IVOL ETF, is to really give access to that market, because it is where lenders lend money. That's what, the term structure of interest rates, policy rates are set by the central bank, by the Fed. But where lenders lend money in the future is largely a result of growth expectations and inflation expectations. So we think a healthy upward sloping yield curve would actually be a really positive sign for the US economy.